All right, good afternoon, everybody. Anybody out there? Tate's with me. Glad you stuck around, Tate. Private afternoon meeting for Tate. There's a few more of you guys. Good afternoon. All right, let's do this disclosure. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is the accurate, updated position disclosure. I got out of my NVIDIA short. Like I said, I got out of it into the close. Made some money in it. Definitely a little bit disappointing. I was looking for more follow-through on it, but getting any follow-through to the downside in this market has been virtually impossible. Let's talk about it. So, all right, the SPYs here closed 0.13% down. The Qs 0.16% down. The IWM down a full percentage point. So, relative weakness out of the Russell again. SPYs and Qs closing flat, in my opinion, is bullish. Time continues to be a bull's friend, and that's really what I want to talk about. I want to talk about time and extension and flow kind of all together in our afternoon meeting today. All right, so popping over the daily chart, this market's had like a miraculous move. I mean, this August is one for the record books. It really is. This has been one of the most unique months of trading I've ever experienced over the course of my career. There have been times of tremendous opportunity over the course of this month, and in my opinion, there have also been times that have been very difficult from a trading perspective over the course of this month. This is not how markets typically trade, which is basically just in straight lines. Straight line down, straight line up. I mean, I think we're like 10 positive days in a row or something like that for the S&P at this point. I mean, this movement back to the upside in such a short period of time is absolutely mind-blowing, and we've managed to spend the last 4 days now, including today, up in generally what I consider to be extreme extension territory. We pretty much still hung out in that zone the entire day today. It was a very insulated trading session. We have a little bit of a doji up here. Again, I think that broadly consolidation right now is bullish, but absolutely the doji from today could lead to a little bit more of a price correction, as dojis typically represent indecision. Maybe it means that the sellers are gaining some level of control that can pull this market back down. But this volume here is very, very light, and that's one thing that's notable is how light the volume is, and I'll go back to the reason why in a second. And the flows are just super strong. So you're fighting these very strong, systematic, uncaring buy flows that have to come into the market. The thing that threw me, I think, as I'm analyzing my own trading here, because I'm short. I'm net short. I'm too heavy, honestly. I'm heavier than I should be on the short side, given all the data and the facts, and that was one of the reasons also why I just kind of took my money and ran on the NVIDIA trade. Again, recognizing that we have a doji here today. This market could still give a strong price correction. We are still broadly in extreme extension. SPYs are still extended by $10. The Qs are, still extended by $11. So I don't want my afternoon meeting today to come off as me throwing in the towel on the short idea. That's absolutely not what's going on. But with the gift of some degree of hindsight and an update on just having more knowledge on the market flows right now, I do think that my short game plan started too early, but even more of a problem is than too early is probably too aggressive. I'm very aggressively short for me compared to a market that is $10 of upside extension normally. And part of that was by design, because not only are we sitting here at $10 worth of extension, it was from the biggest degree of downside extension that I've almost ever seen in my career, one of the biggest ones I've ever seen in my career, to that upside extension. So, and again, with the knowledge that typically markets don't work in straight lines. So being earlier and being more aggressive was initially part of the game plan on the short side and I even had said it out loud back on like August 12th. I thought that they were going to overshoot the upside. To me, overshooting the upside was a move to mid 540s, upper 540s, certainly not 560. And now here we are trading at 560 again with the ADMA sitting below 550. That's going to catch up a little bit further tomorrow. So time will continue to make us less extended as we move sideways and don't get the big move. But I think that the missing piece of my puzzle when it came to the development of the game plan for me on the short side that had me be as aggressive as I am and as early as I am, which is not realizing just how fast these systematic flows were going to come online. And for that, I want to refer to a couple of things, starting with Pat's note from today. I really started to realize this information over the weekend when I was doing my research, but by that point it was kind of too late. And as you guys know, I'm a big believer in following game plans on trades after they're already set. So at that point I'm kind of already in the trade. I'm going to continue to follow through with it. But here's the really important paragraph. It's right in here. This is from Goldman, and it's from Goldman actually summarizing to some degree Scott Rubner, who is also at Goldman and has an entirely separate note. His note tends to focus on a lot of the flow factors and market dynamics that we spend so much time talking about. But Scott Rubner at Goldman has basically been pointing out that the pain trade for equities is higher over the course of the next few weeks, as the bar for being bearish into Labor Day is high. Okay, but here's the reason why: CTA releveraging, target vol and vol control, plus this is a whole separate factor, the unwinding of puts, the unwinding of a lot of insurance that market participants put on into that market implosion that we had, and corporate demand, that's stock buybacks, will act as tailwinds as sellers are out of ammo, forcing fundamental investors in higher. And now here's the really important line. Between systematics, that's your CTAs, your vol control, and your risk parity funds, and corporates, buybacks, we estimate there is $12 billion of non-discretionary, unemotional demand which will drive larger impact. And here's the next important line that I've also been talking about, that will drive larger impact when adjusted for August liquidity. Liquidity right now, as we've been discussing, is very low. It's always low in August. Everybody's on vacation, and it's been a wild couple of weeks probably to be on vacation if you were away. But it's always period of time here where there's just lower liquidity. So think about that number. This $12 billion number of buying. That's a per day number, by the way. It's like $5 billion from the CTAs. It's like $5 billion from the corporate buybacks. Right now we're in a open window for corporate buybacks to be buying back stock, and the other $2 billion or so comes from the vol control and the risk parity funds. Though I want to circle back on the vol control, because there's actually a lot of risk to the upside that the vol control funds really start to step things up. But for some context, $12 billion is a really big number as far as the equity market goes, where typically the entire full number of the market itself on a day-to-day basis is $50 billion. It's $50 billion of like day-to-day overall flow that actually creates the gain and loss of trillions of dollars of actual market cap. So, when you think about that, it's like 25% or whatever of the flow that will happen on a day-to-day basis is this non-discretionary, unemotional demand. It happens pretty much no matter what. Now, the number can have adjustments a little bit. Like if you look at the CTA numbers, if the market were able to go down, then those CTA numbers become a little bit less than if the market were to be higher or flat. But overall, the demand picture is still there. Now, coupling that with some other information I have that I'll just read off on a different screen here that comes from Nomura. So, and this goes back to the thing that is where I really feel like I kind of made more of my mistake, is I just didn't realize just how fast into this degree of an up move that these types of funds are going to have to re-leverage themselves. The CTAs have already bought back in $36 billion of equity since August 6th, which is the day after the low. So just since August 6th, they've already bought back $36 billion. That's the CTAs specifically. So how many days has it been? 3, 4, 5, 6, 7, 8, 9, 10. That's over the course of 11 days, they've bought back $36 billion of SPX, basically. The interesting one, though, is the volatility funds, because they've actually only bought back $5 billion so far, and it's the volatility funds in some way. Like the CTAs, we know, are actually still very big buyers, right? We know that. Like I just said, just $12 billion of buying per day right now. $5 billion of that is coming from the CTAs alone. The scarier one in some ways is if the realized vol of the S&P stays low, meaning we continue to get days like today where the market is down or up less than 0.5% by the close, coupled with where the VIX is beginning to trade. That's going to then actually bring back in a tremendous amount more of demand from the vol control funds that hasn't even started to really come online yet. Over the course of the next 1 week, if these movements, these S&P movements, stay within 0.5% up or down, then it'll be $10 billion that begin to come in over the course of a week from the vol control funds. But the scary one is actually over the course of 2 weeks. And this is an estimate that comes from a chart that Nomura creates that I have on a different screen right here, that I just don't want to share this one on the screen share. But if over the course of the next 2 weeks, the average movement in the market is 0.5% up or down or less, then it'll create an additional $53 billion worth of forced buying. And that then all of a sudden becomes a really big number, since over the course of the next 2 weeks. So when you look at that number in the context of what we were just reading here from Rubner, who's really saying, that the pain trade is actually very much higher here for the market, it goes back to then my thought process of like, oh man, like, well, I don't want to be. Look, I always want to have some shorts on it for $10 to stand up for the market. I just don't want to be as heavy as I am. And I'm not going to change my game plan because I'm very stubborn with my game plans, because I think that game plans actually create consistency. But this is a really, really difficult time to be short. We had a little bit of a window of opportunity here in the beginning of this week, because Gamma totally rolled off at the end of last week. But now every day that we hold up and every day that we go positive, that Gamma number increases also, which also makes it even more difficult for the pullbacks to come in. So it's just like everything you look at from like a market dynamic perspective right now in this period of time, for this week, for next week, unless a real event happens. An event can always trigger anything, but you never want to bet on a major event. I guess Jerome Powell could say something crazy, or you could still have, an Iran situation, or I don't know, some other black swan event that I'm not foreseeing. but you don't want to bet on that. You know, I really think that you don't want to fight the flow. You want to think about everything in terms of context and in terms of layers of probability. So for me, still, you know, at $10 plus worth of extension, where we've been for the last 4 trading sessions now, I want to be short. But the truth is that my short game plan here is the most aggressive short game plan that I've used in years, to be honest. And that was back before this week. That was back last week, when I didn't have this degree of data that I'm actually looking at right now, where I felt that there was a much higher probability of just getting this push up to 545. Now we just had this massive move that no one expected, that was a $35 bounce, and then we get a sharp pullback, and then we build out a wedge, or we create a higher low, or then we work our way higher. And that just has not been the case. The reason it hasn't been the case is because of everything I'm talking about. The amount of forced buying that's been coming into this market literally every single day. And then you also have to combine that with the fact that this is an illiquid tape. So you have all this forced buying in an environment that has less supply than it would in another period of time, just because there aren't as many traders at their desks right now. So it's just really, really difficult to get the pullback. Now, at the same time, varying pieces of information, because when I look at the information that we just discussed, that tells me I don't want to be short at all. When I look at the fact that I'm $10 extended from the market, where the short-term tactical was in the red for this morning, that means I want to be short the market. But what do I do when I've got layers of probability that are counter to one another? It means that I want to be doing things smaller, not bigger. Yet here I am doing things very big, which, you know, really isn't right. And it's especially annoying because I've got like a little bit of a timeline where I don't want to have, and I still have a week and a half here, but I don't want to have these huge index level shorts on when I leave for vacation, which probably will coincide with when there becomes a time for a higher probability of an actual pullback in the market, unfortunately. But we'll take that as it comes. So that's really where it's at. And I started to realize that yesterday. I talked about it a little bit yesterday. I talked about it in the morning meeting a little bit yesterday. You know, knowing the degree of buying that was coming in, yet recognizing this extension. So to me, that means that there then just becomes a much higher probability of a time correction of this extension as opposed to a price correction. Can we get a price correction back down? Sure, we can. But every day that goes by where we didn't have it, that reward profile of a correction down to this ADMA becomes less and less and less. This catches up. We're already kind of correcting through time, and the scary part about this time correction is it's not even really been a time correction. It's been a grind higher. We've continued to kind of grind higher on Friday, move higher yesterday, and hold in really, really well today. So it's a very, very difficult environment to be short. I still am a believer, and it's been very consistent for me, that when you get this degree of extension, that your risk reward of buying for anything more than a quick day trade is not good, and you shouldn't do it. And your risk reward on the short side becomes better, but that you still want to, you know, really wait for an actual signal to put those trades on. And then you want to have pretty tight reward expectations on those trades, because even like when, you know, we had some pretty good short call outs today. We basically called out the, you know, the high of the day as an opportunity to short for the market, for Nvidia, and we got, you know, a cute little pullback. But I joked, you know, we were so pumped at 1040 for kind of calling this top and getting this pullback, and I joked and I was like, yeah, look at this big sell-off we just got in the market. We're back to where we were trading at 330 yesterday. I mean, that's the type of pullbacks we're getting. These pullbacks have just been so shallow because they're just running into this underlying bid. You want to know where and what this magical underlying bid is? Well, I just explained it to you, and that's why we're not able to get any sort of a real pullback. So, you know, for me, it is what it is. A little bit of a learning experience on how fast, you know, these flows can reestablish themselves under certain circumstances. And, you know, I'm probably going to end up, I still have the trade on, so maybe I can still eke out a gain in this, but there's a good chance that I'll be licking some degree of a wound on the extension short that I put on, just because of how early and how aggressive I started on this one compared to what I've done in other previous times in history. But it is what it is, and it's a learning experience, and we do still have the extension here, so I am still continuing to have my short on. I am still actually very net short this market right now, but I have to recognize that there just becomes a higher and higher probability of time correction, and a higher probability of that as the time goes by, there becomes a lesser and lesser reward profile on those shorts. So therefore, while I did my best to really give this market the chance to pull back for me this morning, and even again in the move higher, added to my shorts further. I added to my Q shorts, added to my Nvidia shorts further into this up move as we were, calling that out, and I stuck with it even here and reshorted a bunch of stock again around noon and caught this move back. By the time this last bounce, like it really was when the Qs couldn't break lows here at 1 o'clock. Like the SPYs and the IWM broke lows, but I saw this candle and I was like so unconvinced by how this candle broke lows and was immediately tailing back up. I was like, all right, this is the same thing. This is the same underlying bid in the market. I'm not getting follow through here. And it was really in this afternoon session after 1 o'clock where I started to, as the ADMA on the daily chart begins to catch up, which is my target. Again, it's a bit of a moving target. I've discussed that strategy in the past. I've now started to slowly begin to piece out of my short here for a loss. With that said, I still probably have 75% of my QQQ short on, as opposed to 80%. So maybe you could say I've begun to realize a loss at this point of 5% of the overall QQQ position that I have, which is pretty small. But if we can't get a bigger down move in the first half of the day tomorrow, then it's going to be me just kind of continuing to piece out and further kind of realize that loss as the time correction happens, as the ADMA catch up on the daily chart occurs. And that's really just kind of where it's at. I don't think I have anything else to say about it. It's just market dynamics. I've started to really learn this over the course of the last couple of years, that understanding market structure and understanding these market dynamics are the most important thing. One of the biggest and best calls, one of the most profitable calls I've ever had in my career, and I've talked about it a bunch of times, but it's just another case in point, was back here when the technicals looked like dog shit, and I said to everyone, I'm like the longest I've ever been in my life. I'm going like max buying power long. I'm buying everything I can get my hands on. The technicals look terrible. Why did I do that? It's because the flows actually looked like what they look like right now. It was about to be the exact same thing as we came into the beginning of November, where it was the corporate buybacks were about to come online in November in a huge way. The CTAs were actually about to become buyers, I think, in an even bigger way than they've been doing now, because they washed out further in that October period. That was one of the things that also threw me a little bit, just with the degree of how much they've releveraged themselves, is that this pull down here, the systematic funds never fully washed themselves out like they did at the end of October. The pullback here in the market just brought the systematic funds from 99 percentile of exposure to 40-something percentile of exposure. It was not the same degree of washout from those funds into this low as it was in this move, which is probably also one of the things that has kept me a little bit more neutral on this market in the up move. Never a full outright bear, certainly not a full outright bull, and is one of the other, I guess, pieces of information that threw me for a loop on just how fast these things are releveraging themselves as the vol selling just continues to come into the market seemingly every day, except for maybe a little bit of a relief in the VIX finally today for the first time. So yeah, I think that's all that I've got on my end. I am happy to take a look at whatever you guys have or any questions that you guys have. Shorts are exhausting. I know what Josh feels like all the time. Yeah, I hate being short. I really do. It's not where I naturally want to be and not where I naturally want to be comfortable. And I always feel so much better. And this is just me personally, and your feelings don't matter when it comes to trading. But I always feel better when I lose money on longs than when I lose money on shorts. I hate losing money on the short side, which is probably one of several reasons why I tend to be just much more patient and much more risk averse coming in on the short side to begin with. And this time around, as we've had this insane move higher, is the one time that I was significantly more aggressive on the short side. Keen saying, I thought that Bears could win a round this morning, but it feels like the judges only gave it to the Bears out of sympathy. Yeah, it certainly keeps feeling like on some of these mornings that the Bears could win a round. But again, you got to just remember that think about how much selling has to come in to overwhelm just the amount of forced bid and forced buying that's actually in the market. It's a large number. And it doesn't mean that you can't have it happen. We did see it happen to some degree in the opposite direction earlier in August at lows. There was a time here in the beginning of this move where some of these funds were still forced sellers at that point. So they sold low to some degree and are actually being forced to bought back higher, which is another reason why there's a lot of risk actually to the upside. The biggest pain trade to the upside right now for a lot of players, to some degree, including myself, is to the move, is to the upside move here. But you had a lot more volume at that low than you do on a day like today, and there was a lot of buying that was able to come in, of unwinding of hedges at that point, that was able to help the market create the initial bounce. And now at this point, if anything, the opposite to some degree is happening, where people who almost probably like myself to some degree started to re-hedge themselves at a certain point on the way up are actually now being blown out of those positions because they're becoming so far out of the money. So yeah, just tough. David York, where does all the money from the CTAs come from? Do they just have unlimited money to buy when the market keeps going up? No, they definitely don't have unlimited money. I've seen the numbers on the total realm, and I don't remember what it is, the total universe of allocation that they tend to have, and obviously they can get leverage on top of that. But what you'll see when, and we did see it, when it happened in the end of February through March, it happened in June into the beginning of July, is that the systematic funds were basically already at that point at their 99th percentile of long exposure. Basically means that they're max all in. And what you see when you look at the same CTA numbers as an example that we get in those periods of time is, yeah, you'll still see some very minuscule, hardly even mentioning amounts of buying that have to come in a flat to up tape, not to the order of billions like we're talking about now. You might see, once they're getting into that 98th, 99th percentile of long exposure, that maybe they'll buy 500 million over the course of a week, which is literally nothing, but it's because they've got nothing left to buy. But they're happy if the market continues to go higher. They don't need to buy anymore. If the market wants to continue to go higher, then they're making money on those long positions. But what you'll see when you get the high levels of exposure at some of those points, and these are the times when then I tactically become much more risk averse on longs, is you'll see, all right, in a flat tape, there's no buying. In an up tape, there's 500 million of buying, which is basically the equivalent of nothing. But in a 2 standard deviation down move, then all of a sudden there is $30 billion or $40 billion of selling. So that's why we begin to say at some of these points in time on the way up, the risk is to the downside. But when you're in that environment, you still always need something to trigger the downside, because it's only, and we even get the levels, right? And this was another actually really good learning experience for me, and hopefully for you guys, over the course of just these last couple of months, is you have to, we talk about how markets work in feedback cycles, right? Buying leads to more buying and selling leads to more selling. That's literally how markets work. That's how trends are created. When you hit that like 99th percentile of exposure that these systematics have, you'll see that they don't have anything left to buy, but they have a lot to sell if they can break certain points to the downside. Again, you still have to have some sort of trigger, some sort of catalyst, whether it's earnings reports, which is really what I think triggered it to begin with in July. It started with the Mag 7 earnings reports, and we nailed it on the head, by the way. We said it after the first 2 weeks of July, which tends to be a very bullish period of time. All right, we are going right after July OPEX here. We're going into a period of time where Mag 7 earnings are reporting. There's very high expectations that AI begins to produce revenue. If the market participants begin to see that there is not a clearer path to the CapEx spending on AI from the Mag 7 leading to revenue, that could be the downside trigger. And that's exactly what happened. And then you need to know, and we literally have the price points, the estimated price points from the sell side researchers who are involved in this type of data on what the actual SPX trigger price is. And I'm trying to remember which day it was. I think it was this day. This was a Wednesday. Am I right? Let me guess. If this was a Wednesday, yeah. Monday the 22nd, Tuesday the 23rd, Wednesday the 24th. This day. This was the day when the sell trigger actually triggered for the first time. JD's down after hours. Why? What's going on with this stock? This was the time when the sell trigger actually clipped for the first time. Was on July 24th. We broke the level. We broke the SPX price point level that triggers that first wave of forced selling that comes in from the systematics. And I remember watching the price action this day, and then I talked about it, of course, after the fact, because I'm still learning too. Where this was one of those days where it was like the market could not tick above that 80 MA on the 5-minute for anything. There was never panic selling. It was just this constant flow of downward sell pressure on the 80 MA on the 5-minute chart that lasted for literally the entirety of the trading session, from the moment that we opened to basically into the close. And I was like, man, like, I even have the data in front of me. I know the numbers. I know the risk is to the downside. I know how much they have to sell. I even know the SPX price point in which the selling begins. Why was I not whacking the hell out of the short in a much bigger way on that day? So also part of a learning experience. But and I guess the final point I would make on your question there, David, and it's a point that I've made in the last few days a couple times, but it's worth mentioning again, is when you can unwind some of the flow and then the market begins to go back up, the fact that you had the pullback makes it easier for the market to move higher. And the example that I've used is, it was in the back half of February and throughout March, actually this entire period of March, that the market, the systematics were sitting at that 99th percentile of, basically being all in. And we're saying in February and March, the risk is to the downside, the risk is to the downside. But guess what? Remember, the trend is your friend. And if we can't actually trigger to the downside, then it doesn't matter. And the market, continued to kind of trend higher, and then it triggered. And this was an unwinding effect here for them. And then, the market stabilizes and begins to move higher, and then at a certain point on the way up, they begin to reallocate, and that slow buying comes in. But we didn't see them get back to that 99th percentile until like somewhere in mid-June, I think, and I'm estimating these dates a little bit, but somewhere in mid-June. Now compare the price points though, right? The price point, and now the entire way up here in May, the beginning of June, this up move in the market is being supported by systematic flow of funds, and it doesn't get back to the 99th percentile until, let's say, $547. The last time they got to the 99th percentile was at $505. So it enables the market, if anything, to be able to create those next bigger waves up, provided that, you know, you have a bottom that comes in somewhere somehow to begin with. Because if that buying doesn't come in, you can actually continue to sell, and you can continue to wash out, and you can bring that positioning even lower and lower and lower, similar to what happened in the July through October period of 2023, which this was a full 10% down move over the course of, 3+ months, basically. And that was how much time and how much price pullback was needed to get this market to go from, once again, it was at like that 99th percentile in July. I remember giving everyone the warning in July of 2023 that the risk was becoming to the downside at the end of the month. And again, August, September, you have some questionable seasonality there as well. And we went from that 99th percentile to being like fully washed out here at the end of October. So you either need to hit the point where you're just fully washed out like you were here, or you just need something to just create a bottom in the market, which, you know, we kind of already were able to discuss what created this most recent one, which was just the dip buyers came in, the vol sellers came in at, you know, VIX 65, and, you know, the unwinding of hedges. If you remember Bill Kay, I don't think he's here right now, he had some things going on. Bill Kay had mentioned at some point in the June and July period, he was letting us know that there were very big VIX insurance calls that were going off for like the August expiration and September expiration. People were just getting that insurance. So there are plenty of people who are the smart players who had insurance for that down move, and then they were unwinding that insurance into that down move, and then the vol compression sellers that are going to happen, like no matter what, we're coming right back into the market as well. That created the initial catalyst to create the initial bid, and then at a certain point on the way up, you just begin to go into this virtuous feedback cycle of buying. Just again, the biggest thing that threw me for a loop more than anything was just how fast that buying actually came back online. Much faster than I thought was possible, and therefore leading to the error that I kind of created in my own game planning for my trading approach. Pat, do you see anything on that, JD, or no? I'd love to know if you actually see what the news is, as I just watch my P&L go down. Definitely not a fun one. Cool. So that covers David's question from Austin. Are the net gamma numbers a lagging number when we get that info? I think that oftentimes we're able to get it on like a 1-day lag. So like we'll get it in the mornings usually as of the close of the previous day. So we're usually pretty accurate on where it is. How is it calculated? So we're getting that information from, you know, big bank research teams who have models that are created based on the amount of option flow that's coming in that creates the gamma to begin with. So I'm not calculating it myself. That's for sure. And you know, right now the best place to get it for you is probably in the VTF. From Vincent, is this the market makers being forced to buy due to bearish positioning, buying puts, expecting the market to correct, like a negative feedback loop, more put buying, more forced equity buying from the market makers? Yeah, so you know, what the market makers are trying to always do, what the dealers are trying to always do, is be fully hedged, and that actually is where you get the gamma from, right? So if an institution buys a large, well, usually what happens in this market environment these days is they sell. If an institution sells a large number of calls, and a market maker comes in on the opposite side of that because they're required to, so that market maker just bought a lot of calls, then what they're going to do is they're going to sell the market itself, to stay basically fully hedged, and it's that actually creates the gamma. So when based on how the market moves in a positive gamma environment, which is where you are the vast majority of the time, in order for market makers to stay hedged, as the market moves higher they have to sell, and as the market moves lower they have to buy. In a negative gamma environment, which happens a little more rarely, it's the opposite. As the market moves higher they have to buy, as the market moves lower they have to sell. Right now, I don't know what the number is. I know that this was another number that surprised me on how fast we got back up to this number, but I think we were at like 8 billion of positive gamma on Friday, and then on Monday we were back to 0. But the price action from yesterday, the price action from today, I don't know by what amount, and I haven't seen an updated number. It adds on additional positive gamma every day. Every day that we're not getting these big outlier moves, there's more gamma coming back into the market. So, and then that creates more of a quieting effect on your volatility, which feeds into itself again. Walmart is shopping a block of JD. I didn't know that Walmart owned JD. That's the news. How much do they have? Vincent giving us a different headline. U.S. listed Chinese companies are trading lower after China's central bank left its 1-year and 5-year loan prime rates unchanged. Wasn't that out? That was out this morning, though? That was out this morning. So this probably looks a little more. Baba's trading down a little bit also, but they might just be sympathy plays for people who don't know what the hell's going on. So it looks to me more like Josh's headline would be pretty accurate here, if that's what's happening. Anyway, what did I miss? From Cameron, can we go over what an RDR is? Yeah, sure. So an RDR, it stands for Red Dog Reversal. It's a trade that Scott Redler has named after himself, but between us girls, it existed before Scott Redler named it after himself. It's the same thing as an 80-20 trade. Same thing sometimes you hear, because Scott Redler named the trade after himself. You guys thought it was funny to rename the trade after me. Sometimes you might hear it as a DOO, Derrick Oldensmith overthrow. People call it that sometimes also. RDR, DOO, 80-20 trade, they're all the exact same trade. Basically what it is it's a counter-directional trade designed to take advantage of going the other direction after big moves. So typically you need a minimum of a 2-day move in one direction. So you get 2 big up days or 2 big down days. What's that going to do? What will 2 big up days or 2 big down days do to a stock or to the market? It'll make the market become extended, right? So then on your day 3 or your day 4 or your day 5, at some point after the market's become extended, after a multi-day move, that multi-day move needs to be 2 days at a minimum. Sort of minimum, you're looking at day 3, but again, sometimes it's day 4 where it triggers, or day 5 or 6 where it triggers. Basically, it's a trade to go in the other direction to take advantage of that extension. So with the market as an example, I guess technically we had a little bit of an RDR today. We'll see if it gives follow-through, where we had several up days in a row. I mean, we could just take the last 3 days here, 3 big up days in a row. Today's day 4. So what the idea behind the trade is, you have to get that stock, or in this case the market, to be above the previous day's high, so that pushes out your next wave of shorts, it gets your next potential wave of longs in, and then you trade back down through the previous day's high. And in this case, because it's an upside extension move, you could do the exact same thing on the downside. You short back through the previous day's high versus today's high. That's the technical right way to trade it. So if you did it today, you'd be shorting back through 553.86 in the SPYs with a stop loss at the day high, which is maybe 557.32. So you would take, you would be taking like $1.23 in risk if you took that trade on today. And your reward profile on that is, it's the same idea of corrections. Your reward profile on that is basically a correction down to the equilibrium areas defined by the space between the 8 and 21 EMA. Ruther just calls it red dog reversal. I think that's a misnomer. It should be called red dog retracement, because you're not betting on a reversal, you're betting on a retracement of an extended move when you're on that day 3, day 4, day 5, etc. So that's how it works on the short side. It works the exact same way to the long side after a really big downside move. You're on that day 3, day 4, day 5. You look the other way, back through the previous day's low, stop loss at the current day low. That's pretty much how it works. Sometimes I find that the risk to the day high can be too much. So sometimes when the trade is actually triggering, I try to find something on the small time frame to utilize as a stop loss instead of just using the day high. Sometimes you can do that, sometimes you can't. And then more recently, I've started to experiment in certain situations with doing like little mini RDRs as day trades on like a 5 or 15 minute chart when you get a lot of extension at a certain time of day. If you get big upside extension to the upside or the downside, I think I was even calling for it. Here's a potential trade in the SPYs, so it never actually triggered for the 5 minute, which could then correspond with the daily chart, where we just had like, you know, whatever this is, 6 big upside green bars in a row. There was extension on the 5 minute chart. If this bar could have gotten above the previous day's high, you could have shorted it as like a 5 minute RDR, looking for a retracement just to the space between the 8 and 21 EMA on the 5 minute chart. But then recognizing that there could actually be more downside follow through based on the daily chart actually giving the same pattern and having that trigger. So I like to find the small time frame patterns that trigger for the big time frame move, if that makes sense. So that's what that trade is. From Dennis, can we talk on the dollar? There has been nonstop dollar selling, and after August 15th failure of 103, there's been nonstop big supply. When and where is that going to become an issue? Correlation to equities is flipped in July. Yeah, so that's a great commentary, and I don't have the DXY specifically, but I've got the UUP, which is the dollar ETF. It's definitely something that we want to pay attention to. There's an interesting relationship between the dollar and the market. Traditionally, a weaker dollar will mean that your assets, your risk assets, commodities, equities, will trade at a higher price because the dollar is worth less. So, you know, less dollar, like the dollar being worth less means that you need more of them to own the same value of your commodity or of your stock. So therefore, stocks can move higher. And I do think that relationship to some degree is still overall in effect. And I know you mentioned it flipped, and you're correct, but I mean, look at this move the last few days. The dollar's been weakening out, and the market's been moving higher. So it's actually like kind of regained its kind of traditional inverse correlation there to some degree. We did see a period of time in July and August, and it was related to just the yen blow up, where the opposite came into play, where we wanted the yen to actually weaken, and this is a little concerning actually, how much this yen is beginning to strengthen again. We wanted the yen to weaken and the dollar to strengthen to create stabilization for the equity market, to mitigate the risk of that yen carry trade issue, which was one of several factors that created the VIX spike and the market mini crash that we had just over 2 weeks ago. So I think that the way that I'm looking at it right now is that a weak dollar is bullish for risk assets, provided that the dollar doesn't weaken so much against the yen that it somehow triggers a knockoff impact of further implosion of the carry trade. And now to answer that question, though, you'd have to answer a different question, which I don't know the answer to, which is how much of that carry trade got just totally blown out at this point, where is there a further risk to a big unwinding of that trade, which led to an unwinding of risk assets, which led to an unwinding of the equity market? Is there a further risk of that trade kind of reinvigorating itself as the yen moves higher? And my general thought process is that, based on what I've seen, is that the majority of that trade got washed out. So I don't know how much, or if any, degree of an upside yen move at this point could actually enable such a large destabilization event. I'm sure there's a trigger point somewhere, but I think that the bar for that is much, much higher than after what we just saw 2 weeks ago. So I think broadly, unless you get such a big currency move that it triggers a big problem like that, I think that broadly a weakening of the dollar here is actually bullish again for the equity market. So, and I think that's what we've seen a little bit over the course of the last couple of days. I find that very generally one of the more important factors when it comes to currencies, or also with interest rates, isn't just the movement, it's the speed of the movement. That the very fast moves in currencies or in interest rates can have a destabilizing effect that then throws everything else out of whack, as far as your kind of typical correlations that you've been seeing between interest rates and equities, or currencies and equities. So that's my best stab at it. Plus more buying power for other currencies to purchase U.S. equities. Yeah, potentially. All right. Let's see. Where am I? Scrolling through here. Yep, that's right, David. DOO is better. Let's go. Say RDR again. Oh, a Red Dog reversal, like Scott Redler. He's this other T3 guy. Pretty nice guy. He calls himself the Red Dog. Calls himself the Red Dog, and he named a trade after himself. 144.5 million shares, huh? Walmart still on the bottom. All right, looks like I got through everything in the VTF for now. Popping over to the YouTube, Qs for sure look like they would break 478 this morning. Yeah, I was just concerned that that underlying bid would hold this market up, and that's what happened. But it is what it is. From you, Vixie Bull. Highest time frame question: who wins, fundamentals or market structure? In the very, very big time frame, fundamentals. But you have to look at a period of time exceeding 10 years. Fundamentals win in a 10+ year time frame. Anything less than that, and it's technicals and market structure. Even if you look, and I didn't realize this, actually, I only learned this somewhat recently, which, shame on me, I was an economics major in college. The efficient market hypothesis, which I've always loved to poo-poo on, as does probably every trader, because, just look at the market. Look at the market, right? Look at the market for August, and tell me where the market traded efficiently this month. But I actually only realized that efficient market hypothesis that he won the Nobel Award for, or whatever, is actually also just based on a period of time that exceeds 10 years. So maybe that's actually accurate, but we are traders here. So, and sometimes I can have a pretty big time frame for some of my trades, but I'm not thinking about, putting a position on right now that I'm going to be in it for 10 years. I have investments that I expect to be in for my entire life, but not trades. From Kevin G. Do you have any expectation on tomorrow's 2 p.m. Fed minutes when thinking about market dynamics? No, not really. I think that the Fed minutes tomorrow are going to be too backwards looking at this point to have any impact. They don't take into account the last couple employment numbers, CPI. I think that they're going to be too backwards looking to have any impact. I'm sure we'll see a little volatility at 2 o'clock when the minutes actually occur, but that's probably it. From Formula One in the YouTube, can you share your thoughts on the position of crypto ETFs? It feels like Bitcoin has been consolidating under all-time highs forever. Is a possibility for an expansion soon. I don't think that this Bitcoin chart looks good. It's consolidating at the lower end of its range after that breakdown. Has not been able to recover as well as most other risk assets. Your breakout level for IBIT's all the way up at $41. So I don't like it. I don't like crypto. I'm biased against it to begin with, but I don't like crypto for a variety of reasons. I don't like the technicals, which is probably the most important thing, and I think that the stuff is a worthless scam. So that's just my thought process, and I keep slowly becoming a little bit more enthusiastic when I say that, because I keep challenging people to try to give me a reason why this is actually worth anything, and it's not. I mean, even look at this move. Oh, I got Bitcoin. I'm hedged from a market pullback. Yeah, right. It's like owning, I don't know, the NASDAQ on crack or something is the way that it moves. Except at least when I own the NASDAQ, I know that I own Apple, and that when I purchase an iPhone, where's my camera? I just created value for Apple, and I just created value for the NASDAQ. From Alan, I think the extreme swings in the market recently is some evidence that big players are slow to execute, selling heavily when the market is down and buying heavily when the market is up. Do you think it's momentum funds, volatility, or technical-based CTAs selling bottoms and buying tops? CTAs seem to underperform regularly, but unsure if they are risk-adjusted or absolute returns. So when you're dealing with any rules-based approach system, there are periods of time in which it excels and periods of time in which it doesn't do as well. One of the periods in time in which those have not done as well actually has been August, because there was a lot of forced selling that occurred from vol funds and from CTAs basically at these lows, and they're selling low and buying high. But the data prior to mid-July was that the CTAs had been making a lot of money this year, and that's because, again, you think about it, we saw a constant releveraging of CTAs starting from the very beginning of November that reached its 99th percentile at some point in mid-February, and then yet the market was able to continue to move significantly higher when they were at their max long leverage, for another 2 months before an actual pullback occurred. So they crushed this up move. And then, sure, they deleverage a little bit into this down move, but where they're deleveraging to and the percent in which they delevered from is still, that's all for them selling, and yes, to some degree selling at the low, probably, but selling at the low in the money based on when they bought. And then they're, re-leveraging back up very quickly to the point where, some point in mid-June, they were, again, back in their 99th percentile, yet this market continued to move higher and higher and higher, and then they began to sell in a really big way, if I remember correctly, on this July 24th date. Well, guess what? A lot of that July 24th CTA selling, that's all in the money still. The only time that they've really started to take any losses in anything that they've been doing this calendar year, from my understanding, has been in this August period, where this gap and VIX move was so severe that some of what they bought on the way up, they were probably selling at a price lower than they bought, and now they're actually having to rebuy that stock on the way up here. So I think for the most part, it's actually been a fantastic year for systematic funds, and then they're giving back a little bit of performance in August. Hope that helps. Whew. Yeah, exactly. And you know, if you're an investor and you got something that's in the money by a huge amount, you don't even need to sell your stock if you want to spend the money anymore. You can just borrow against it, and then you don't even have to pay capital gains. I think, you know, for the wealthy investor class, it's just a whole additional way that came online here over the course of the last handful of years. This is what Bates's commentary in the VTF on the not needing to sell. Why realize capital gains, especially when interest rates were lower, when if you want to spend some money, you can just take a loan on it, and that's it. Until we have the unrealized capital gains tax. Yeah, right. Yep. That'll be, markets will cease to function if that happens. All right, looks like I got through everything in the VTF and in YouTube. It's a bit after 5 here, so I'm gonna wrap things up. It's crazy. Have a great night, everybody. I will see you all tomorrow.